Welcome to Proper Wealth with me, Paul Mahoney, here at the Nova Café. We have Chris Davidson today, the MD at Discover Development Finance. But first, Nick Wallwork, the founder of Property Forum. So Nick, why property? The big question.
Well, property is a fabulous investment depending on whatever your goals are. It can give you, depending on the specific strategy you go for, it can give you either a short-term investment goal, it can hit those goals, or it can do a longer-term solution. So I guess I like property because it's flexible. There's lots of options within it. It's not just set in stone. You have to buy a share and just watch that share go up and down. Yeah. It gives you lots of control. You can decide how much control you want to have and how much involvement you want to have in a particular deal. And sort of everything in between. It can be highly tailored to the investor. Yeah, there's
a broad range of options out there, isn't there? Different types of returns, whether it be income focused, growth focused, different locations. They give different capital values and all sorts of things. Which absolutely. I think perhaps in some cases where people sort of misconceive property is the fact that it's a sort of large purchase price, large exit costs, all that sort of stuff, and that kind of turns them off sometimes.
Yeah, can do.
Not necessarily understanding the broad range of options out there.
Yeah, and in this day and age, deposits are hard to get. You know, the competition for properties is tricky. The undersupply in the UK specifically is hard. So you're fighting lots of people to get that property, and cash is king. So having a bigger deposit or an investor to back you as an investor can really help. So definitely, you know, to get in can be tricky, but there are definitely strategies out there where it's a lot easier, and working with people like yourself can help open up opportunities people might not have seen on their own.
Yeah, okay. What would you say are some of the key fundamentals for people to look out for? You know, specifically if we're talking sort of mum and dad investors, people that are looking to get involved in buy-to-let. What are some of the key things they should look for?
Well, I think, you know, capital growth is one side and income or yield is the other. So there's sort of two main factors you need to be looking at there. I think depending, you know, I couldn't give any specific advice without speaking to a particular client, but those are the two main broad areas they want to be looking at. So depending on if they want a 2-year return or a 10-year return, they need to consider, you know, is it a short-term fix or is it a 20-year pension? I like to invest on yield, on income, and let the capital growth follow. So you've got to make sure that your mortgage and all your bills and your costs are covered. If there's any fluctuations in interest rate, if there's any market changes in rent, that kind of stuff, you don't want to be caught out in the short term and have to subsidise your mortgage. What you thought was an investment suddenly becomes a liability, and that's not good investment. So whatever it is, I would say focus on the yield, in my view, focus on the yield first, and take the capital as the cherry on the cake, and look at that as a longer term view that should come, almost certainly in the UK, if you pick the right area and things like that. But a combination of the two.
Okay, so essentially deciding what their goals are and sort of reverse engineering that to determine what works best for them.
Yeah, absolutely.
So there's no one size fits all, is there?
No, absolutely. It's
unfortunate.
You've got to look at the individual circumstances, and I guess to add to that, risk profile comes into it. So you'll find certain people are more risk adverse and they're worried about what their investment might bring. They might go for a slightly lower yield property that's lower risk. It's not always the case that higher returns give you a higher risk, but it can be. So you've got to factor in the risk profile for someone as well. That's key.
And I suppose the thing with property is, in the right locations, people always need somewhere to live, don't they?
Absolutely, and that's fueling the undersupply of property in the UK. We're not building enough houses. We haven't, matched the deficit of housing in the UK for many, many years, and that gap is getting worse often. So we're struggling to build. Recession hasn't helped, and since the 2008 recession, developers have come back. A few years after that, when finance started to come back for developers, they've built a lot more stuff, but we're still not building fast enough.
Yeah, some pretty interesting stats on that I was reading recently was that the requirement is 300,000 new units per annum.
Right, okay.
And we've been averaging about 150,000.
Yeah,
so about half the requirement.
And that's just on year. So essentially, to clarify that stat, you're saying 150,000 homes are getting worse each year. Deficit's getting bigger every year. So the problem's getting worse. And what that will potentially do is increase rents, it'll increase demand, and the government are doing certain things to try and help this. It seems like an attack on investors, but it's not meant that way. It's meant to keep the market sensible. Things like the stamp duty changes and things like that. It's all there to try and keep the market even, and all any investor really wants. We don't want a boom and a bust, and I think property investors are given a bad name sometimes in the general press. We're not there to make a quick buck. We're not there to make loads of money when the housing price housing prices boom, we want a stable market. I mean, I would like to operate in a almost completely flat market with slight rise in line with inflation at the very least, but you can make money in that market. What you don't want is uncertainty.
I think that's a very good point. I think a lot of people perceive landlords as being these fat cats counting their money, but generally they're normal mum and dad people that are just looking to better utilise their resources.
Create a pension and create hopefully a small legacy to pass down to the kids, and also support the market. We need houses, and we need investors to be able to buy those if deposits are too high and it's hard to provide those houses. We need a combination of government supplied housing and subsidised housing for key workers and things like that. There's some good schemes out there for that. We also need investors. So I think there's an opportunity there if you're a sensible investor to make reasonable returns and provide a good quality service and good quality housing, which is much needed.
And I suppose we're talking there quite a lot about supply. Demand is probably the other side of that equation. The simple law of economics when it comes to making any investment, and for some time now that's been quite heavily weighted in favour of property investors, hasn't it? So it's
absolutely, and I think don't forget immigration. There's been over the last 10 years there's been a large influx of people moving to this country, which fuels the population growth as well. So it's not just, like you say, the supply, it's the demand as well from both sides that affects the number of people that need housing.
And when it comes to locations, is there any tips you'd give there on sort of selecting? Because obviously the UK is quite a broad market. Different areas are very different to other areas.
Absolutely.
Is there any tips you'd give there on selecting a suitable location? I suppose it depends on the outcomes you're hoping for, but just in general? Yeah,
good point. I wouldn't sort of pinpoint any particular location per se. I would give some more general advice, because I think investors should also, if it suits them, and some investors are different, invest maybe locally if it's more hands-on. If it's more hands-off, I think the location is less important, the proximity is less important, I should say.
Right.
In terms of the location, you want to be looking for either city centre locations or on the fringes of city centres. So sort of very easy walking or very short commuting distance into town centres, train stations, good commuter belts, good towns that have got a good professional population. So if you're investing, you've got to think about your tenants. You've got to think about your exit. Are you looking, for a long-term tenant? So you've got to look at the business in that area. You've got to look if there's inward investment from the government in terms of transport links, in terms of new business parks. Walk through the town. Is it a town that looks like it's going downhill, or is it doing well? Is there the odd new housing estate popping up as well? There's a lot to be said for piggybacking on the back of some of the bigger developers out there. If you see them going in, they've probably got a 10-15 year view to build so many houses. You might want to get involved in that area as well.
Yeah, absolutely. I definitely agree with that central location sort of tip there, so far as investing in markets with depth.
Absolutely. Well, to caveat though, I would personally steer clear of London unless you are a gambler and you like extreme capital growth, ups and downs. There are plenty of good investments there, I'm sure, but with London in particular, do your due diligence. There's a tongue twister for you, because it's its own micro market. It tends to be the first to be hit when there's a property crash, and it tends to be the first to boom. So it's got the most extreme fluctuations, and it's got its own microclimate in terms of investing. So that can be riskier if you don't know what you're doing, and with the prices being so high, you tend to get lower yields. Your return from an income perspective is lower, so you're going to struggle to pay your mortgage and all your costs. So something to consider there.
And I'd absolutely agree with you. I think especially in the current market. And that kind of leads on to another point, is some of the changes that are happening at the moment, or have happened and are continuing to happen with regards to buy-to-let mortgages, mortgage serviceability, stamp duty premiums. The list goes on and on with changes that have happened recently and are making the market a bit more complex. So certainly something we've noticed is a shift in the market away from high-value, low-yield assets. Predominantly London and the southeast, more so toward lower value, higher yield assets, which really minimises the impact of most of those changes.
Absolutely.
That's quite an interesting trend that we're noticing in the market at the moment.
Yeah, it is. It is interesting, and I think there's still very much a strong opportunity to invest in property as an asset class. Certain changes, like you say, the stamp duty changes and things like that, have made it harder, but not impossible. You shouldn't be investing in an individual property if 3% is going to break the deal. I think that's the message: is look at your due diligence on the deal, check the numbers work. An extra 3% here and there, if that affects the deal, you shouldn't have probably been investing it in the first place. So just a little bit of extra due diligence margins are getting a little bit more squeezed. So that'd be overriding advice really, is look carefully and don't necessarily be put off with
absolutely. Something, I suppose, our take on property when it comes to comparing it to other options, as far as what you can invest in to create wealth, is the real differentiating factor is the leverage. The ability for the mortgage. The fact that you can take a 25% deposit and leverage the rest, so quite high loan to value ratios at low interest rates over the long term. In most cases, with no ability for that lender to recall that money.
No, absolutely. And the debt is being eroded by inflation as well. So it's a double whammy with the leverage.
Exactly right. So that enables you to achieve 20% plus returns per annum on your cash without setting the world on fire.
Definitely.
Which I think, when you show those numbers to people, often they're quite surprised because that seems like a very high number.
And if you compare that with the equity markets, for example, and the only way you can leverage, I say the only way, I'm not a stock trader, but there are other ways to leverage. But things like futures and things like that, and options are ways to leverage in the stock world. But they're highly risky. You can lose all of your capital quite
and
easily.
Margin loans, if the value of your equities were to fall, then of course you get a margin call, you need to sell or put in more money at the worst possible time. So I think that is one of the biggest differentiating factors, not just the returns, but also the stability.
Absolutely.
We mentioned that.
Bricks and mortar.
Exactly.
Can't beat that.
We mentioned so far as people actually needing somewhere to live. And even in a recession, people don't just disappear, do they?
No, absolutely. And what we found in the last recession was that our property portfolio that we'd built up before that got us through that recession because rents were still solid and in fact very quickly recovered and were stronger. Rents have been going up pretty much since 2008. So where the capital values took a hit, as long as you don't have to sell and you become a distressed seller, provided you can service the mortgage, you keep the property well maintained and looked after, or you have someone to do that for you, the rents will cover you. You just wait for the capital values to come back. That's why I said I think it's important to invest on yield, and then capital comes after, because the capital will fluctuate and you have to accept that.
Completely agree. Thanks very much, Nick.
No problem.
After the break, join me for a discussion with Chris Davidson on property development in the UK and development finance. Welcome back. And with me now is Chris Davidson from Discover Development Finance. So Chris, tell me where the development finance market's going.
Well, Paul, at the moment there's quite a lot of changes going on, and that's both for the people that are buying the units as well as the guys who are building the units. So for developers, their margins are getting heavily squeezed wherever you're looking. So whether that be high land prices, could be on the construction costs, and the GDVs with Brexit that's been done to death is very uncertain at the moment. So developers, in terms of what leverage they have in terms of where their profit margins are struggling for answers in many ways. So time is certainly one leverage that a developer can use in terms of really shortening the cost and actually increasing the profit. And they can do that using new construction technologies that really quicken up the time of build, or they can look at projects that aren't ground up. So for example, permitted development schemes, where the structure's already in place, they're making a higher purchase to start with, but ultimately the margins are greater. They can turn these projects around in, at times, half the time of...
So for those who don't know, could you just explain permitted development rights and how that's working?
So permitted development is, and at the moment in the UK, is based on converting office to residential. So if you're someone who maybe doesn't like the green belt being built on and think, well, where are we going to get all these new houses from? There's quite a lot of office stock, particularly in the cities, London, Birmingham, etc., which are 10, 15, 20% occupied. So the idea is tenants will move out of those properties, they will be bought. Permitted development it's a fast track planning service, so it takes 56 days to go through.
And I suppose that's being done to just better utilise the current stock that's on the market in a vastly undersupplied residential market.
Absolutely. Well, at the moment, properties keep going up, and trying to get the supply in there will help everybody.
And how do you help developers sort of reduce their costs and improve on those squeezed margins you mentioned?
Okay. Well, we work with over 40 different lending options in the marketplace, and what's happened in the last 10 years is the development finance marketplace has exploded out of all proportion. You used to go to your bank, there would be 3 or 4 of them, and you'd have an easy product there. With the increase in choice, it's become harder and harder to choose which lender to go to. So we help in terms of analysing the finance products at a really deep level. Interest rate isn't enough. You've got to look at how they apply the interest rate, what the fees are based on. And actually, across 40 lenders, or your top 4 or 5, comparing apples with apples is a really difficult thing to do.
Are there any mistakes that you see developers making, or misconceptions they might have that they could, that could help them improve their strategy?
There's quite a few, but I suppose the main failure to plan properly.
Yeah.
So your asset and liability statement is a key in terms of being able to qualify and service loans on a long-term basis. Mistakes that developers make. Chasing a cheap interest rate when they're putting down a lot of cash up front. So for an extra 2% on the interest rate, you might be putting down, which might be 50 grand in interest, you might be putting down an extra 300 grand on the purchase. And actually that's stopping you leveraging up on 2 or 3 different sites. So different strategies they can use, and it's about, I think a lot of it's about the planning before you go looking for
Great, that sounds like good advice. And with the recent PRA changes and how that might affect both developers and their subsequent buyers, how are you seeing that affect the market already, and how do you see it affect the market moving forward?
Yeah, it's a great question, Paul, because the maybe 25% of stock for any development is going to be bought by buy-to-let investors, and with the new PRA changes really hampering buy-to-let investors in terms of they've got to put a lot more money down, they'll be buying less stock. The impact, I don't think we've seen the impact of this yet, but if we look in probably 6 to 12 months' time, I think you'll see less buy-to-let investors buying into developments, and probably harder to shift those last 20-25% yields.
Yeah. So what I'm hearing you say, Chris, is that there seems like there's some challenges at the moment for developers and also the subsequent buyers, especially buy-to-let investors. But I suppose that's restricting supply, and the other side of that coin is that the demand is continuing, so property prices might continue to rise. So it's an interesting market at the moment, I think.
Yeah, it's someone's always benefiting, aren't they? You're either benefiting because you own the property already, and everyone wants to profit out of their property. I think that the key is at the moment that we've got a dearth of people who can buy first-time houses. Those are the key areas around the country. Yeah. More and more lenders are looking further afield from London and the southeast. And again, it comes down to micro-location. So there's still opportunities. It's location again.
Yeah. Okay, Chris, so we spoke a bit there about permitted development rights and some of the opportunities that are offered there so far as further supply and already available stock. One of the challenges that we've seen recently is with the availability of buy-to-let mortgages on the already converted PDR type stuff. The buy-to-let lenders don't seem to be saying it outright, but what we've seen is in more regional areas, the availability of the mortgages is a little bit limited. So I think something that's very important for both developers and subsequent buyers is to assess the availability of those mortgages to make sure that their investment is actually viable. That's something we found quite interesting and surprising that I'd say most people probably aren't aware of.
Yeah. No, very much so, and it's always about the end in mind. So, if finance has been taken to a developer, then he's got to be thinking, the lender's thinking about the exit strategy, the developer's got to be thinking how he's getting out. And I suppose specifically with permitted development, there's no national strategy for permitted development. You go into different areas of the country. In some areas it's banned, it's not allowed. Yeah. Certainly, some developments, the buy-to-let investors are not able to get mortgages. So, at times in property in general, there's not this joined-up thinking nationally about everyone's working off different agendas, and how can we actually bring together a strategy that's going to benefit everybody and frankly isn't wasting everybody's time. Yeah. So no, certainly it's an issue that I think needs looking at a national level.
The due diligence needs to be done from both ends.
Yeah, sure.
Okay, great. With regards to developers overcoming perceived issues, whether that be with bad credit or rejections in the past, how can they do that?
I think a lot of developers get quite discouraged about the idea of, well, I've been to my bank won't fund me, therefore there's nothing I can do, or I'm looking at a horrendous bridging rate, so why bother? And certainly some of the developers that we speak to, we can show them that actually that's not the case. So for example, if we take credit history, most lenders will take a view about credit history, and a good lower mid-market guys will take a view on bankruptcy. And bankruptcy, if it's to do with 2008, where there was nothing anybody could do about that. So, and frankly, if they didn't lend to the guys from 2008, they would be lending to most of the marketplace. Right. So provided you're upfront with lenders, they like an honest, communicative relationship. They're happy to take a view. What lenders don't like with bankruptcy is if you've overtraded, you've been involved in fraud or some sort of criminal activity, and believe me, guys try and hide it and think they're going to get away with it, but ultimately they don't.
Myself.
They think they're going to get away with it, and lo and behold. So It's always worth asking the question. I mean, another area, for example, would be guys who don't have any cash to put in. I can't get any funding because I need to put in 20% equity, 30% equity. It's not the case. So with some lenders, they can get 100% funding, and there's 3 or 4 different methods and strategy you can to do that.
Okay.
You can partner up with equity investors. There are 2 or 3 different investment vehicles that can bring the 100% together. If you've got additional security, then you effectively you're getting part of the loan from another property. There's different ways of doing it, and actually developers who have quite often it's developers who are tied up in 1, 2, 3 projects, want to do 4 and 5, don't have the cash. So it's always worth asking the question.
And very high level, what sort of information should developers have readily available when it comes to looking for development finance?
Okay, so if they've got a site and they're ready to go, good due diligence on the site. So we're talking, the lender's going to lend on GDV, have your comparables ready. Make sure you understand that easier to do, say, in central London than it is to do on the North Wales coastline.
So they want proof of the NGDV, the end
They'd like
value.
to, yeah. It's all about evidencing for the lender. So that will be, if the developer's the contractor or there's another contractor, show us the, evidence the cost. That will come out with a quantity surveyor. In terms of paperwork, we always start with the asset and liability statement. So a developer has to service a loan, and they will be asked to sign a PG at around about 20-25% of the loan.
Right.
So, and that's calculated on their owned property and cash. So it's a good starting point in terms
assuming
of...
for that they would actually need to have that available in equity or cash in some way.
Yeah, or they partner up with someone who can provide that, who can effectively act as a loan guarantor. So this is why it's so important. Before you go looking for funding, you've got all your ducks in a row. You know what you're looking for. Other paperwork, development appraisal, the cash flow schedule. Cash flow is key in terms of actually showing what your costs look like, and it makes you look professional. So yes, there's 5 or 6 different things that need to be in place.
And once you have that in place, actually finding the finance, what are the mistakes you see people making when it comes to doing that, and what should people actually be doing?
Well, wasting a lot of time online. There's assumptions on searching for finance vary, but essentially you're either looking for recommendations from your accountant or your architect, or you're going online on Google. And as with anything we buy on Google, we think all the best options are on page 1 or page 2, but actually those are just the people who have paid the most money. Yeah. So in development finance, there are at least 40 decent options, and some of those don't advertise. So it can cost you a lot of time and a lot of money if you're missing out on good lenders, you're not evaluating them correctly, and there are ways and means of shortcutting that process, and frankly that's using good industry professionals who can save you a lot of time and money and getting to the right place quickly.
So seeking advice is quite important.
Yeah, I would say.
Okay, some great tips there. Join us next time on Proper Wealth.